So I'm going to be going over some things when the S&P 500 doesn't look so clear, the market direction doesn't look so clear, the NASDAQ isn't helping enough. I'm going to give some other tools you can use to help pick a direction. Or if none of them are giving you a good sign, just sit out of the market, right? And wait till something good pops up. So the three main things I want to point you towards is number one, people neglect futures. Before I even started trading futures, I was watching the futures market whenever I was trading SPY, QQQ, things like that. I would always be watching the futures market. Has more price action. It's very liquid. And this is the main way that bigger traders, hedge funds, institutions, they trade. They use futures. A lot of them do. And so it gives you 23 hours of price action per day, 6 days a week, which is very nice because the more information, the better I can prepare myself for the market, right? Another thing is, so futures is kind of obvious, right? But we're going to talk about some of the things that are not as obvious. So the first thing is going to be the dollar. So we talked about this a little bit with people on live on Friday, but we're really going to get more in depth with it. So the idea is that so the dollar has value. Sometimes the dollar is when the dollar's worth less, things are cheaper. And when the dollar's more, opposite, vice versa. But the main point is when the dollar is higher in value, like going up, the market should be declining. Usually they move in an inverse correlation because if the dollar is worth more than stock, that means stocks are worth less. So that's why we want to pay attention to the dollar, how it moves, and what it does. So first thing we want to pay attention to, the ticker symbol is DXY. And so really, you do the same thing. Pretty much all the things I'm going to be showing you besides one thing will be regular charting. So like you'll just be charting the dollar index as a regular chart. Like as you can see there's a bull flag here. You can see consistent higher highs and higher lows. You can see a little triangle here. You can see a correction and then move higher. And you can also see that we may be forming a head and shoulders. So like maybe a head right here, head, or sorry, shoulder, head, shoulder, and somewhat of a neckline right around here. So, but if we look at the bigger time frames, it looks like we were breaking out of some sort of consolidation that we formed here. So like right in this area, it looks like we were breaking out of that. And here, so the first thing is the dollar. We want to pay attention to its price action, what it does. This is something that I didn't know about or pay attention to really in the past. But as you can see, as we've been declining in the market, you can see the consistent uptrend we've had in the dollar. This is a weekly chart, so this has been happening for a few years now. So that's something to pay attention to. But the main point is that it typically moves inverse in terms of the correlation with the stock market. So this is a good tool. The same thing with the VIX, they move inversely correlated. I did a full breakdown of the VIX before in a previous webinar, but the VIX is another one that you really want to pay attention to. Measures the volatility in the market, or some people call it the fear in the market, and it helps you give you a good indication of where the market's going to head next. So when we saw that big move, that big push down earlier this week, that was kind of confirmed, or we could see that setup forming when we saw this bull flag on the VIX, and then we had that huge push up. So I've found in my own trading that a lot of the times when the VIX is matching up with the trade idea that I'm taking in the S&P 500, typically makes that trade that much better. It's more confirmation, and the move is usually a lot more significant. So you can see here, like, for example, we were in this consolidation for quite some time, and we continued to create this little pattern, this falling wedge type deal, and ended up breaking out and having that huge move. So how we could have known this was going to happen and set up is, or in the market when we had this drop here and here, that could have been pointed out by what was going on the VIX. We had this bull flag, and then as soon as that bull flag broke out, that's when we had this breakdown here on SPY or ES. And so same thing here. If we take a look, when we had that breakout, you can see the two different breakouts. So there was the first one here where we broke out, but then the second one we also had here as well, which led to the big decline the other day as well. So something that I noticed when I was looking at these two charts was we had a pattern forming here, this downtrend line, so setting up for a breakout. And I also noticed on the VIX, we were forming this flag at the same time. So it was kind of like a double confirmation from two different sources that the market was kind of going to break down. And then we also had a trend line breakdown that also gave us more confirmation as well. So that's kind of how we could have saw that big drop that happened the other day. Now, something that's interesting is they don't always correlate. So you can see the market was pushing down, and we kind of had a choppy day on Friday. But what's interesting is that the whole day on Friday, we were selling off on the dollar index. And that's interesting because it wasn't a correlated movement. Now, taking note of that, so we had a huge drop. So usually this means it's bullish for equities or the S&P 500. And then we go back and look here, and you can see we had a nice drop, but then we were bought right back up, which is interesting because of this, because we dropped the whole day. So you can see we didn't have that great of a move is the point that I'm trying to get across. We didn't have that great of a move when we broke down because in part, it wasn't backed by the dollar's move. Like it failed this flag that it formed. It had a flag and it failed it. So the move wasn't backed by the dollar, so it doesn't make the move as strong. And same thing with the VIX. The VIX was probably pretty overextended, and so we couldn't expect too big of a move. Even though you could have noticed that flag that we formed here, we did have a nice breakout of it, but ended up giving back all those gains in terms of the S&P 500. Okay. So one other thing that I like to use when we're looking at these here is something that I like to look at. So first is the dollar, second is the VIX, the next thing is the 10-year. So the reason why I like to look at the 10-year is because it's rates, it's what the Fed deals with, it's what they pay attention to, just the ticker's 10Y. And I like to watch this to see what bonds are doing, and it gives me a good idea. Bonds usually move in an inverse correlation. All these different things move in are supposed to move in a inverse correlation to the S&P 500. So that's also something you want to pay attention to, is all three of these things are not directly correlated, but they are supposed to move in the opposite direction. And it's somewhat alarming, like when the VIX is green, but the market's also green. If the VIX is red and the market's also red, those are things that you want to pay attention to that are unusual. Like when the dollar was dropping on Friday, but we saw in equities that we were selling off as well. That's abnormal. The dollar should be rallying when equities are headed down. So that doesn't make a lot of sense. So that's something we want to pay attention to as well. So those are some correlations that we need to pay attention to. Same thing for like when we saw the VIX and the S&P 500, like you can see we had a nice push up, but it was interesting because the VIX didn't continue to break down. It held this lower zone here that we've been holding this whole time or the past few years. So that was something to pay attention to as well. So we had a breakout, and you can see we popped off this demand zone, which would have given us a pretty good telltale that we were going to pull back soon because the VIX could not break this weekly demand zone. and then we had a setup to follow it. So like we had an inverse head and shoulders. We had that breakout, fake some people out, pulled back to this demand zone, and then ended up popping out of it. So next we can continue, or we can pay attention to and watch. The next place we want to pay attention to see us kind of top out would be somewhere in this area here. So I'm gonna extend this and I'll keep that on watch. As for, they all just move in different ways. Like the dollar moves like a currency, FX. It kind of moves like a stock a little bit, but it has trends. They all have trends. The VIX has a lot of patterns more than trends. It doesn't trend as much, but the VIX has more of a patterns. Like you'll see triangles, falling wedges, a lot of inverse head and shoulders, double tops, all those different chart patterns. You're going to see those a lot in the VIX. So that's something to pay attention to in terms of the VIX, like things to look for when trying to find complements to your trades. The VIX, you would be looking for chart patterns, and then like supply and demand, and it typically trades within a range. Okay. The dollar, you're going to chart it like exactly like a regular chart, support and resistance, looking at its trend, looking if it has chart patterns, things like that. The 10-year, same exact thing, chart it like a regular stock, and pay attention to its movements. It's typically going to move in an inverse correlation to the S&P 500 like the rest of these. Now, there's one other thing that I like to pay attention to, and people that have been around for a long time know I watch this. I haven't been watching it that much recently, but I've been paying attention to this. So the VIX, I know a lot of people like to use this, but it gives a good indication. So what you do is basically how it works is it gives a reading. This is called the put call ratio. It gives a reading between basically how much puts are being bought up in the market and how many calls are being bought up in the market, and gives you a single number based off that. And you find the range in between all of this of like extreme values. So let me explain that a little more. So first is when we're up in this higher range, when the number shows to be in this higher range, each of these are day candles, by the way. When it shows to be in this upper range, that means that there is very bearish sentiment in the market, which means puts are being bought up. We're at higher levels than we've seen in a long time. So that's something that is showing up here. That's actually what currently happened on Friday. There was a ton of put buying. So basically what happens is this is kind of like a contrarian indicator. So when there's a extensive amount of bearishness or put buying in the market or bearish sentiment, typically the market's going to reverse in the opposite direction. So a lot of times what you will look for and how you trade this is when it's down here, that means everybody's bullish. So you're going to want to look for bearish setups. Vice versa, when it's up here, that means everybody's bearish. So you're going to want to start to look for bullish setups. So this doesn't always work perfectly to the T, but a lot of times when it's reaching these extreme zones, the market turns around on a dime. A lot of times. It doesn't always work. You got to use a stop loss, obviously, and manage your risk. But a lot of the times when you find it in these extreme areas, like down below here, below 60, or above that range of probably like 1.2, you're going to see pretty dramatic direction changes. And so how you can see that kind of correlated is on Friday when we tried to sell off, we just simply couldn't. And that's because of there was too many people bearish in the market. I don't have this on my thing, so I'm going to make sure to add that back. So here are kind of your indicators. Everything are so put call ratio is kind of in its own world in terms of reading it and understanding it. I have more videos that go more into depth on this, but if you have questions about it, let me know. But we've got a lot of videos in the trading education tab for this. But so that put call ratio is different from the rest. But then when you look at these, you're kind of charting them like a regular stock or how you would chart any other chart. And you're looking for reasons when this is, I mean, all of them are inversely correlated to the market. So you're going to be like, if this is looking bullish, then you're going to want to look for bearish setups in the market, vice versa. It makes a lot better of a trade when the VIX is matching up, or the dollar, or both, preferably. Put call ratio, this is more for day traders. Like, I like this intraday. Like, when I see this intraday, it's overextended. It usually can give me a good move for the next day or two. So short swings or intraday trades. So do you guys have any questions in terms of this stuff? And understanding how they work? No, we're good. Okay. Well, that's all I have for you guys today. We have CPI coming out on Tuesday, so I wouldn't be too active trading. I just wait for that data to come out so we can have better sentiment of where the market wants to head next. But thank you guys for coming, and I will see you guys in the chat.